Hey there, and welcome back to the Deep Dive. You know how sometimes you look at a big stack of company reports and feel like you need a secret decoder ring just to figure out what's really going on? Well, consider us your guides today. We're aiming to cut through the noise, pull out the important stuff for you. Today, we're diving into the latest from Deepak Fertilisers and Petrochemicals Corporation Limited, DOPCL for short. We've got their board meeting outcome from July 29, 2025. So that includes their unaudited financials for Q1 ending June 30, 2025, standalone and consolidated, plus some details on auditor reappointment and a pretty comprehensive earnings presentation they put out.
Right. And our mission today really is to give you a clear, sort of concise understanding of DFPCL's Q1 FY26 performance. We'll look at the key numbers, the financials, strategic moves, future projects, the things that really matter. It's about getting that knowledge quickly, but, thoroughly. So you hopefully walk away with those aha moments without feeling totally bogged down.
Okay, let's unpack this then. Because DFPCL, well, they certainly had quite a notable quarter to kick off FY26. They reported a really robust 17% year-over-year growth in operating revenues.
Yeah, and an impressive 22% jump in net profit after tax. That's significant.
It really is. So we're going to explore, what drove these numbers and what it might signal for the company's strategic direction going forward.
Exactly. And looking at the specific figures, their consolidated operating revenue hit 2,659 crore. That's a solid increase from 2,281 crore in the same quarter last year.
Okay.
And that net profit after tax, it surged to 244 crore, up from 200 crore. What's particularly insightful here, I think, is that this isn't just a one-off good quarter for DFPCL. If you look over the past 5 years, their Q1 results have actually shown pretty consistent growth. We're talking a compound annual growth rate, a CAGR, of 9% in revenue, and a remarkable 15% in EBITDA. That's earnings before interest, taxes, depreciation, and amortization.
Right, a key profitability indicator.
Absolutely. And that 15% CAGR and EBITDA really speaks to a sustained kind of disciplined trajectory. It reinforces the strength of their underlying business model.
Yeah, absolutely. It really highlights how that consistent strategic approach can lead to, well, durable growth. Let's talk about the segments, though, because there's quite a bit of interesting movement there. In industrial chemicals, for instance, their nitric acid volumes saw a 15% year-over-year increase.
Right.
And isopropyl alcohol, IPA, sales volume jumped an incredible 27% year-over-year. I think they mentioned some plant modifications helped there.
Yes, that's right. They did some debottlenecking. And even with, as you mentioned, some price pressures on IPA globally, that segment still saw a 29% revenue surge year-over-year overall.
So they managed that well.
They did. It shows they're navigating varied market conditions pretty effectively. I mean, despite the softness in IPA and also ammonia prices, which actually led to a 9% year-over-year decline in profit for the chemical segment overall.
Ah, okay. So revenue up, profits slightly down in chemicals.
Exactly, but they maintain strong performance by focusing on specific customer applications and differentiated products. That seems to be their strategy. And their capacity utilization rates, 100% for diluted nitric acid, DNA, and an impressive 113% for IPA that also tells a story of highly efficient operations.
Wow, 113% for IPA.
Yeah, running above nameplate capacity. The outlook, well, it suggests stability for nitric acid, but probably continued pressure for IPA prices. But their strategic segmentation, it's clearly helping them navigate these dynamics.
Okay, and what about the crop nutrition business? Because
Yeah.
the story there sounds remarkably positive.
Oh, definitely.
Their specialty product, CropTech, reported an exceptional 73% year-over-year growth in sales volume. That's huge.
It is. And specialty fertilizers overall, things like Bensulf Superfast and SaluteTech saw a robust 21% year-over-year volume growth too.
So the whole specialty area is booming for them.
It really is. And the result, this business segment delivered a truly impressive 125% year-over-year growth in profit.
Wow, 125% profit growth.
Yeah. If we put this in perspective, this robust growth in the crop nutrition segment, it's a clear outcome of their strategic shift. They've been deliberately moving away from commodity-based products towards these differentiated crop-specific solutions. Specialty products now account for 45% of the crop nutrition business revenue. That's a big chunk.
Almost half, yeah.
And their direct engagement model is interesting too. They connected with nearly 1.77 lakh farmers through over 3,500 activities. This isn't just, good PR. It demonstrates a powerful blueprint for customer-centric growth.
Right. Understanding the end user.
Exactly. By directly understanding what farmers need, they've not only boosted sales but also built brand loyalty. It shows that in these niche markets, direct relationships can be, well, incredibly valuable, more so than broad marketing sometimes.
Makes sense.
And with a normal monsoon forecast for June-September 2025, Kharif 2025 is actually poised to be a very strong season for their Mahathan brand.
Okay, good outlook there. That deep engagement clearly makes a difference. And then there's the mining chemical segment.
Yeah.
It's primarily technical ammonium nitrate, or TAN, right?
Correct.
Their sales volume there grew 7% year over year, and they maintained full capacity utilization. Again, 100%. What's really interesting here, though, is that even though export volumes were apparently lower due to some quota constraints in Q1, they've just had their export quota increased in June 2025, up to 50,000 metric tons per year. That sounds like a pretty significant development for future quarters.
Oh, it is. It's a crucial strategic adjustment for them. While Q2 is typically a bit softer for mining and infrastructure demand because of the monsoon season, this increased export quota provides a significant avenue for growth.
Right, it offsets the domestic seasonality.
Precisely. It allows DFTCL to maintain momentum, keep supporting key industries, and really solidify its position as a major global player in TAN. It just reinforces their commitment to operational agility and global market reach.
Okay. Speaking of future momentum, DFPCL is investing heavily in growth. It's actually exciting to see their major capital projects progressing. The Gopel technical ammonium nitrate plant is, about 80% complete?
Approximately 80%, yeah. And the Dahej nitric acid project is around 57% complete. These are massive investments.
They really are.
These two projects, together they represent a combined capital expenditure of 4,661 crore. Gopalpur is the bigger chunk at 2,675 crore and Dahej at 1,983 crore. And importantly, both are apparently on track for commissioning by the end of FY26. So within the next year and a half or so.
Big milestones coming up.
Huge! Once operational, that Gopalpur plant will make DFPCL the third largest pure-play TAM producer globally.
Wow.
And the Dahej project will position them as Asia's largest manufacturer of nitric acid.
Asia's largest, okay.
So a significant commitment like this, it naturally raises an important question. What about the demand for all this new capacity?
Yeah,
right?
exactly. Can they sell it all?
Well, here's an interesting point. 65% of the new nitric acid capacity at Dahej is already tied up. They have a 20-year long-term contract securing that output.
Smart move. De-risking it early.
Demonstrates some clear foresight regarding their future output, yeah.
That's a powerful commitment to future market leadership. And like you said, sounds like they've de-risked a good chunk of that new capacity already. Now, on the financial health front, you might expect such heavy capital expenditure to strain the balance sheet, wouldn't you?
You might, logically, but DFPCL is actually doing the opposite, which is quite impressive. Their net debt reduced. It went from 3,305 crore in March 2025 down to 3,078 crore by the end of June 2025.
Reduced, even with the cap.
Reduced, even with that significant capital expenditure of 377 crore just in Q1 FY26.
That's quite something.
It is. It's a testament to their robust cash flow generation and pretty prudent financial management.
And there's more good news on the financial side, too.
Yeah.
That legal win.
Oh, yes. The critical legal win for their subsidiary, Mahathan Agritech Limited. The Income Tax Appellate Tribunal, the ITAT, their ruling nullified 581 crore in tax demands.
581 crore wiped off.
Wiped off. And they also expect the cancellation of about 479 crore in associated penalties.
Wow. That's a huge relief for their balance sheet, surely.
Massive.
Wow.
This debt reduction, despite the capex, is one thing. Their net debt-to-equity ratio improved from 0.53 times down to 0.43 times.
Better leverage.
Yep. And net debt to EBITDA decreased from 1.72 times to 1.50 times, getting healthier. Additionally, their short-term debt stood at zero, reflects improved working capital efficiency.
The zero short-term debt. Okay.
So that ITAT ruling, it just provides substantial financial headroom on top of all that. It allows them to redirect resources towards strategic growth rather than being tied up in legacy tax disputes. It's a very clear signal of strong financial stewardship.
Okay, so if we pull it all together then, DFPCL's Q1 FY26 performance. We've got robust growth across segments, these strategic capital projects steaming ahead, and really impressive financial discipline. What's the biggest takeaway for you from this quarter's deep dive?
Hmm. The biggest takeaway, I think if we zoom out for just a moment, DFPCL's Q1 performance paints a really compelling picture. It's a company that's actively executing a clear, long-term strategy. You can see the pieces fitting together, the consistent growth, that disciplined shift towards specialty products we talked about, and the impressive debt management, even while they're investing heavily for the future. It all just underscores the impact of their strategic transformation. They're not just growing, they seem to be growing smart. They're making calculated moves.
Growing smart. I like that. Okay, so what does this all mean for you, the listener? Maybe consider how a company's ability to strategically shift its product focus, like DFPCL is doing, how it successfully manages its debt even while investing heavily in growth, and how it navigates these complex legal challenges. Could this serve as a kind of blueprint for long-term resilience in today's world? Does this kind of discipline, execution, and clear vision represent maybe a new standard for industrial conglomerates aiming to thrive in what is, let's face it, an ever-changing economic landscape? Or perhaps are there hidden risks lurking within such an ambitious blueprint? Something to mull over until our next deep dive.